Welcome back to Trading 360. It's time for the 360 round, all about the PPI report, CPI, inflation. Tony Welch is with us, Chief Investment Officer at Signature FD, and Chris Schuba, CEO of Helios. Thank you both for being here. Tony, what is this immaculate disinflation? What does that mean?
So, I kind of call this the immaculate disinflation because we've managed to not really destroy the labor market. Actually, by many metrics, the labor market still looks pretty tight. Yet inflation has been coming down. It's been coming down at one of the quickest rates since the 1970s, 80s period. And it's been able to do so without a lot of pain to the labor market. So this is this kind of so-called immaculate disinflation that we've been seeing.
Yeah. So both the PPI and CPI have been going in the right direction. The CPI slowest annual rate increase since March of 2021. The PPI was cooler. Ex-food and energy, the smallest gain since February of 2021. So things are going in the right direction. But within the CPI, the shelter component is more than a third of that CPI print. So some of the analysts think it's peaked, that there's a reversal coming. Chris, what say you?
I would agree. I actually really like the immaculate disinflation. I'm going to steal that, I think. But I 100% agree that we're at that point in the data where we can start to reasonably suggest a soft landing is in play. The trend of both CPI and PPI are exactly in line with the data sets that we need. We have, if we aggregate the score of the economy, we'd give it a 40 out of 100 right now with 50 at the midline. And that's an improving score, even though somewhat weak. So I'm in that camp. I've been there for a long time that a soft landing is in play given the trajectory of both CPI and PPI at this point.
Understood. Tony, when I talk about rents, for example, in the month of May, it grew at about 4.8% from a year earlier. And that was a significant slowdown from the 15.7% growth we had seen a year prior. What do you think is driving everything? Do you see a recession even coming?
Well, I don't see a recession in this year. I mean, I think there's still a lot of job loosening that can happen before we get into any sort of recessionary territory. And I think what's significant about that is kind of the way investors were positioned going into this year was for an early year recession, which is now starting to get pushed off further and further, and now out into 2024, possibly longer. So I don't see recession coming this year, but eventually we do have to consider that the job market will soften to a point where the slack is starting to really build up. And then it's going to get a lot more tricky. When a lot of those kind of job economic moats are behind us, you're going to be left with tight real interest rate policy. You're going to be left with tough credit conditions, and that kind of sows the seed for recession. But I do not think that's a story for this year.
And what kind of market narrative, Chris, are you looking at this point? I mean, you still have an inverted yield curve. You do have the S&P and NASDAQ at new 52-week highs. I think people like that. You had to have owned tech, really, to have made money this year. But what kind of market narrative are you looking at between today, where we have a Fed announcement, July will be another Fed announcement?
I'm cautiously optimistic on the overall market right now. And some things that I like that I'm seeing are, number one, the broadening of the rally. We've all been concerned about how narrow the rally has been with just a handful of names really driving the majority of the returns leading up to the end of last month. But that's starting to broaden out here in the last couple of weeks as some of the other S&P 500 names have kind of come into their own a little bit. And I also like that I'm seeing a recovery in mid and small caps, getting through the banking issues that we saw, that credit crunch that's there. So nobody loves the market right now because of all the externalities going on, the Fed being one of them. But I like where it is, and I like some of the things that I'm seeing. I'm not saying there's going to be no volatility for the remainder of the year, but I'm in agreement that until that yield curve fixes itself, until we start to see that come down in rates, I think that's what's pushing out the eventuality of a recessionary discussion. So, I'm in that camp that this year could be all right.
Yeah, could be all right. And Tony, you said no recession this year. Where are we in the market cycle, and what's your advice to clients at this point?
So I think the breadth has been a major brick in this so-called wall of worry this year, right? Is the market's only been led by a handful of stocks, and that's been the common refrain. We are seeing some broadening out here. I do think that the back half of this year is going to be more challenging than the first half, but that doesn't mean that it's bear market territory. If you kind of consider just presidential election year cycles, the first half of the pre-election year tends to be very, very strong. The back half tends to be a little bit softer than the first half. In the broad scheme of things, I think what we've been through is a very traditional market cycle, though it doesn't really feel traditional. So we've been through this cycle of we had a recessionary bear market that was associated with COVID. We had a post-recessionary bull market coming off of that. Then we had a growth scare in 2022 with 2 consecutive quarters of negative GDP. That resulted in a bear market, and now we're in the recovery phase from that. And that recovery period, that recovery bull market, that can last as long as the economy takes us. So sometimes that can last for periods of years, oftentimes surprising investors. So that's kind of where we are in the market cycle.
Right, right. And Chris, if a soft landing is possible, I mean, what do you say here for the markets, investors, and you think a soft landing is possible, right?
I do, and I've always been a prove it to me with the data type of person. So as long as jobs has remained strong, I'm going to be in the soft landing camp. And what's going to change that for me is going to be 2 data points. The first is going to be productivity data, and the second is going to be wage growth. We have to get wages to a point where they are above the inflationary rate for a period of time so that people feel wealthier as time goes on, because we know that a sustainable rally in the marketplace cannot be held if people aren't consuming. And secondarily, productivity has me a little bit worried. We're losing hours worked per week, even though we're creating more jobs, which tells me there's a rotation in productivity, maybe some higher paying white collar jobs we obviously know are disappearing in certain areas, and lower paying service jobs are coming into play. So there is a threat to the jobs market right now. We have to pay attention to that. But given the current data set, things are good. And so I'm still on the soft landing at this point. Once jobs cracks, though, the hard landing's back in play.
All right, Tony Welch and Chris Schuba. Thank you both very much. Good to see you. Thanks.